So this is financial statement analysis, and we're looking at 2011 data. You can follow along with current price data if you want and replicate the process using any different company, or you can follow along with Apple Corporation as well. So we start off part A. We're going to construct a price target. Part of this is about the selection of a comparison company. I'm showing you two different comparators, Google and Hewlett-Packard. So Google, we might think, is quite similar to Apple. They both have mobile phone technology, and also they have software platforms. So we start off with Apple's share price. This is at 2011. You can follow along with current data if you want. So we take that share price from Yahoo or Reuters or Google Stocks, and we put that in, and then we're going to multiply it by a multiplier type, which is the price earnings of the competitor divided by the target company price earnings. So first off, I select Google as the competitor. So in the numerator, I put Google's price to earnings. That's what an investor is prepared to pay $1 of earnings in their share price. So it's 19.43 at 2011 for Google and 13.26 for Apple. So we multiply this by the share price of Apple, because we believe that in this calculation that Apple is on the trajectory of Google. So it's going to follow Google's price earnings. So it gives us a price target of $375.75. So when we compare this to their share price at this point in time, $366.99, it's greater. So that if we believe this and we think it's an appropriate comparison, we're going to do a buy of this stock. Now let's look at Hewlett-Packard as a competitor. So both of them sell desktop computers. So if we think that Apple is on the same trajectory as Hewlett-Packard, we can do our price target calculation. So Apple share price multiplied by Hewlett-Packard price earnings divided by Apple's price earnings. Noticing Hewlett-Packard, it's only $6.05, so it's a lot cheaper to buy a piece of the earnings of Hewlett-Packard, $1 of their earnings, than Apple's at $13.26. So the price target we get is $167.44. This is lower than the current share price of Apple, so we would do a sell recommendation. So part B, we can think about giving a reason why is this peer comparison appropriate. I've sort of touched on a bit of this, but we can put these words down. So Google is an appropriate comparison with Apple because they're both in the mobile phone market. They're both making software for mobile phones. We can put that reason in. What about Hewlett-Packard? They both manufacture, sell desktop computers, or they license out that. So they're in the computer market. Part C, we think about why are they not a good comparison. So Google has their search engine and they're involved in different areas than Apple, so it may not be a good match. And Hewlett-Packard is not in the mobile phone market, and they don't have the same fan loyalty as Apple does. Nobody lines up outside a Hewlett-Packard store for the latest desktop computer. Part D, we can think about special situations that might affect your analysis. So think about you're communicating with someone about an investment choice. They may not be as informed as you about the market. So you can look for newspaper articles about a particular company, find out what's happened. So in 2011, there was the death of Steve Jobs, who was the CEO of Apple Corporation. He was very influential, and losing him put a very different situation for Apple. They may not have that same creative inspiration, and you would need to communicate that to a potential investor. So more recently, another situation could be the expansion into motor vehicles, where Apple is looking at the iCar and also the iWatch. So they're expanding into existing highly competitive markets. So this expansion may be successful, may not, it might overextend the company, but that's something you would communicate to a potential investor.